Welcome to the deep dive. Today, we're taking a really fascinating journey, I think, into a company that builds, well, the very foundations of our infrastructure and homes.
That's right. We're looking at Astral Ltd.
Exactly. And we've got some great sources and investor presentations, some detailed financial analyses, basically, to unpack Astral, our mission, give you that shortcut, understand this major player in building materials from their basic operations right through to their financial health.
Let's get into it.
Okay, so let's unpack this. Astral Ltd. They kicked off back in 1996,
Yep.
and they're not just a company. They feel like a titan in this space. We're talking over 8,900 employees.
That's a significant workforce.
It is.
Yeah.
And exporting to more than 31 countries, 26 manufacturing units across 3 nations.
Wow.
But here's what really jumped out at me, their reach. How they actually get products to you.
The distribution network.
Okay. Over 250,000 dealers.
Still.
251,000 plus. And more than 3,600 distributors.
That kind of scale is, well, it's how you dominate a market, really.
Yeah. It's the backbone, right?
Absolutely. And it's interesting, too, how they've diversified.
Yeah.
It's not just one thing.
No.
They're into 9 high-growth categories.
Yeah.
You've got the pipes and fittings, obviously, but also water tanks, adhesives, even paints now.
Paints, yeah.
So given that broad portfolio, and it is a competitive market, how do they stand out? What's the edge our sources point to?
That's a great question. And the sources are pretty clear. They're innovators, like true trendsetters.
Oh, how so?
Well, Astral was apparently the first to bring CPVC piping to India.
Okay, the chlorinated stuff, durable plastic.
Yeah. And the first lead-free UPVC pipes, even pioneered things like low-noise drainage pipes.
Solving specific problems.
Exactly. And get this, antiviral copper shield water tanks, first in India, and even specific kitchen paints.
Okay, so it's a story of firsts, a consistent R&D push.
It really seems to be. It's not just a one-off, it's a pattern. That seems key to how they grab market share.
And if we link that innovation, that operational strength, you'd expect to see it in the financials, right?
You would?
And we do. The revenue growth is pretty consistent. It jumps from around, 1,500 crore rupees?
Okay, so 1.5 billion rupees, yeah.
Right, up to over 6,000 crore, or 6 billion rupees more recently. That's substantial growth.
Definitely.
And the operating profit margins look healthy too, typically sitting between, say, 20 and 30%. That signals good cost control.
Solid margins.
Very solid. And things like return on equity, return on capital employed, basically how well they use money, those figures are strong too, often 15 to 25%.
Okay. And cash flow. Debt.
Good questions. Cash flow from operations looks positive and growing. Free cash flow too. And crucially, their debt-to-equity ratio is low. Plus, interest coverage.
How easily they pay their debt interest.
Exactly. Often way above 18 times in recent years. So they're comfortably handling their debt. Very comfortably.
Our dive showed some noticeable dips around March 2020 and again around March 2023. Those suggest periods where cash generation kind of lagged behind the profits. And that makes you ask, what was going on then? Big investments, working capital changes, something squeezed the cash flow.
That's a great question, yeah. It means even with good overall numbers, you got to dig into those specific moments. Okay, so considering everything, growth, debt, margins, cash flow, what does it all mean for how they're using capital? Managing risk. We should probably look at their debt to free cash flow ratio. Debt to FCF.
Indeed. That debt to FCF is a really telling metric. It spiked significantly in March 2020.
Okay, same time as one of those cash dips.
Exactly. And again in March 2023-24. Now, this isn't just a number going up. It means the company's debt load in those periods grew much faster than its ability to generate free cash.
Free cash being the money left after operations and capital spending.
Precisely. So those spikes suggest times when their financial flexibility was definitely under more strain.
And that really highlights why it's not just about static numbers, but the whole dynamic story playing out.
Exactly right. But despite those debt spikes, it's worth noting their ROE return on equity and ROCE return on capital employed. They've generally been pretty robust, often over 20% in the last few years, say MAR 22 to MAR 25.
That's strong.
It demonstrates that even with those debt pressures at times, they've been, remarkably efficient at getting returns from their capital. And they've also consistently put profits into dividends and reserves while still investing in CapEx. So it suggests a balanced approach, growth, but also shareholder returns and reinvestment.
Yeah.
Okay, now let's shift slightly. Something really critical for, understanding any business, especially if you're thinking about investing. the quality of the numbers themselves.
Financial reporting integrity. Yes.
Yeah. One of our sources gives us this M score. It's a metric designed to assess the risk of earnings manipulation.
Right. Benish M score.
That's the one. For Astral, this score has consistently been negative, like well below the usual red flag threshold of n = 1.78.
So a negative score is good here.
Exactly. It suggests a low likelihood of earnings manipulation. That's a pretty strong signal about financial quality, wouldn't you say?
It absolutely is. It provides a degree of confidence in the reported earnings. But it's also fair to point out we should look at the whole picture.
Of course.
While that M score is reassuring, some other metrics flagged in the same source deserve a look. For instance, days inventory, outstanding.
How long stock sits on the shelf.
Precisely. It's consistently been over 60 days. That could suggest inventory isn't moving as fast as ideally it might.
Okay, something to watch.
Yeah. And there have been, occasional flags popping up over time related to maybe sales growth compared to prior periods or gross margin changes, sometimes receivables taking longer to collect. That leverage, or even things like selling and admin costs growing faster than sales in certain periods.
Right.
So the M score is positive, but these other flags suggest areas you'd want to keep an eye on. It's about seeing all sides.
Absolutely. Context is key. So there you have it, our deep dive into Astral Ltd, a company clearly built on strong operational foundations.
Definitely.
A really interesting history of innovation, those firsts we talked about, and a financial story that overall shows solid growth and, importantly, based on that M score, high-quality earnings.
Yeah, it really makes you think, doesn't it? How every number, every new product, it tells part of the story.
It does.
But also how crucial it is to piece it all together. How much can those maybe seemingly small details or that mix of financial signals really tell you about the true strength and the strategy of a big player like Astral? It's digging beneath the surface.